G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to go and take a deep dive into Tattooed Chef's third quarter financial results. So let's waste no time, let's get straight into it. So finally we got our results after the management team delaying releasing the financial results last week, but we finally got them today. And the top line sort of numbers, we got $58.8 million of revenue, and this is a 44% year over year increase. And if we look at branded revenue, we can see we did 56% growth, and it's increased to $35.3 million. And Sam Galletti sort of gets into some stuff about the company here, where he says Tattooed Chef is now a top 10 brand across the club, grocery, and mass channels in the categories that they compete. They are now in 13,000 stores nationwide, which you're going to be pretty happy about that, considering at the start of the year they were guiding 10,000 stores by the end of the year. And yeah, we just hit Q3 and we're in 13,000 stores. So that's exceeding my expectations. And they say that due to this store expansion, this has diversified them sort of out of the club channel, and is given them a more diverse customer mix. And then on the sort of like top line of this financial results here, we can see Sarah Galletti. She's mentioned that the company will be looking to expand beyond the freezer aisle. This is going to be done through some of their acquisitions that we're going to talk about very soon. But if we jump back and have a think about this, revenue growth here of 44% year over year. Look, I'm not going to lie, it's okay. Like, I was hoping it was going to be a bit higher, but I can't be mad at it, but I'm not overly excited about it. It's probably slightly under expectations. It missed analyst guidance, but I mean, look, it still grew 44%. Like, I'm not gonna sit here and cry about that. Like, yeah, I'm not too worried about that in particular, especially given sort of the circumstances that the company is facing right now. If we look into gross profit, it was $5.9 million, and we can see that the gross margin actually decreased slightly. This is due to inflation. It's due to higher sort of raw material costs, packaging costs, and freight costs as well. You got to remember that Tattooed Chef, they ship a lot of their products from Italy over to the United States, and obviously you need freight to be able to do that. So obviously they're going to suffer a little bit there, especially since freight cost, as we've seen among many other companies, they're reporting 3 to 5 times higher freight cost. And as a result of that, the net loss was $8.2 million, and this is compared to a loss of $3.2 million in a prior year period. But I mean, look, it's nothing too crazy. I'm not going to worry too much about sort of small losses, especially when the company's in growth mode. If they're growing 44% year over year, so I'm not going to worry about a small loss. And we'll actually see in the question and answer session when we get to that the company does plan to reach profitability in 2023. So that's nice. So if we scroll down now, so this is just reiterating the point on the margin compression. It was due to raw material, packaging, freight costs, and container costs due to inflation, as well as the purchase of the 2 New Mexico facilities that will be operational actually in the first quarter of 2022. Already know Foods in New Mexico, they've already started distributing some private label products, but the branded products will begin in the first quarter of 2022. In terms of operating expenses, they've increased from 6 million to 13.6 million in Q3. And I've highlighted the two main contributors to this. The first main contributor is the marketing expenses, which they spent $3.4 million on. And also the new operating expenses for Food of New Mexico, which cost them $1.5 million. But I mean, like I said, this is just part of doing business. This is part of being in a growth company. As part of expanding. I'm happy that they're plowing money into marketing. I'm not mad at that at all, especially when we get into some more information later in the video about how effective this marketing actually has been. So it's cool. I'm fine with it. In terms of their cash position, they've got pretty much $130 million on the balance sheet in cash and cash equivalents. This is healthy for a company that is about $1.3 billion market cap. So their cash makes up about 10% of their market cap, which is actually pretty strong. It's a strong position to be in. And they pretty much have no debt. So that's nice. In terms of the outlook that the company gave, they've actually decreased their revenue guidance and they've pulled it back to be between 110 million to 115 million, which would be an increase of 41% to 45%. Now, this might be alarming, and honestly, it's not the best news, but if you have a look and see what all the other sort of plant-based food companies have been guiding, they've all been pulling back their guidance. Like Beyond Meat pulled back their guidance. Oatly, they pulled back their guidance. Even Celsius, they're not in the plant-based sector, but they're an energy drink company and they pulled back their guidance for revenues as well. But really, it's not that much of a pullback, and at the end of the day, they're still going to grow 41 to 45%, and I do think these numbers are conservative, so I would be quite surprised if they can't reach these targets. Another reason for this sort of pullback in revenue is due to the lack of promotions expected in Q4 in the club stores. Pretty much the company explained that in Q4 a lot of people don't necessarily focus on eating healthy, therefore the sales of sort of plant-based products aren't as strong. And then as we move into Q1, Q2, we'll see these healthier products sort of get a higher uptake as people during the Christmas period tend to sort of indulge more in maybe unhealthier foods. Gross margin, this is going to be in the range of 12 to 14%, as discussed before. This is being compressed somewhat due to inflation, higher costs, etc. Adjusted EBITDA, negative 18 to 20 mil. That's fine. We expected more. We expected it to be negative, and then capital expenditures in a range of 15 to 20 mil. So that's all we got really in this part. But if we now jump over to the conference call, we'll go into some more details. So the start of the conference call started with the CEO, Sam Galletti, giving his remarks. Some of the important things he mentioned was that the Carston facility is set to open at the end of the first quarter in 2022, and they will be selling ambient products out of this facility, which means that they're going to be expanding into more product categories. He also mentioned the agreement to acquire Belmont Confections. This is going to allow them to produce nutrition bars and snacks, and they paid $18 million for this acquisition, and it's expected to close at the end of the year. So this acquisition itself, it's a 47,000 square foot facility, and it's going to allow them to enter the $10 billion global plant food-based category, which is a very big market. Think about it, if tattooed chefs 1.3 billion, and this whole category itself is 10 billion. Look, there's a lot of room for them to sort of take some of that market share and keep it for themselves. And between these two acquisitions, they believe that it can contribute an additional $300 million in annual revenue in the next 2 to 3 years, which if you look at the price they paid for the investment and then compare it to the revenue that they're going to be receiving out of it, I'd call it a good return on investment. It's probably better than good. I'll call it a very good return on investment. So we're going to be happy with that. That's going to help them expand their business, and they're probably going to have to keep acquiring these companies in order to reach their long-term goals. But so far, so good with that. Sam also goes on to mention TDPs. So TDPs are total distribution points, and he says that year over year they've grown over 350%, and their measured consumption has grown 239% through strong growth in club mass and groceries. And he also mentioned that quarter over quarter, we saw consumption sales grow 49%. And what's also really nice is that the brand strength for Tattooed Chef is really strong at the moment. They're the 4th largest brand in total. And it's crazy to think that just a couple of years ago, like Tattooed Chef, it wasn't even a brand. It was just a private label company. And they've taken this brand and now they're the 4th largest in their category. And to be more specific, they're 2nd ranked in health and wellness in terms of those sort of brands. Moreover, they've got 4 of the top 10 best performing single serve new innovation SKUs and 5 of the top 10 SKUs when comparing velocity. So especially with the velocity point, velocity is pretty much how fast the products come into the store and leave off the shelves. And if they continue to have, high performing SKUs with high velocity, quite simply, the distributors and the stores are going to want more of their products. So it's going to allow them to expand their SKUs. And also their pizzas are doing really well. It's it's the number 1 SKU in terms of velocity in the category, and also the 3rd best performing pizza SKU overall. Sam also mentioned that they had a 3-time limited offer on some of their products in the club channel, and in the last 12 weeks, Tattooed Chef, in terms of these products, is up over 64%, which shows that they are still really strong. Whenever they have their offers in club stores, we can see that the uptake is strong. What's also really nice to see is that at Target in October, the company has been able to increase their SKU count in Target to 25, which is pretty massive. Like that's quite a lot of SKUs, and you can't be mad about that. He also mentions that we're now a top 10 selling health and wellness brand, and we're also by far the fastest growing in the category. We've gotten into distributors such as Kroger, Sprouts Farmers Market, multiple Albertsons divisions, and also Heb. So that's insane. That's really good store growth for the quarter, and that was reflected in the numbers. This is actually a really good sort of indicator to track. So the indicator is the total average SKU count per store, and in Q2 it was 5.8, and today in Q3 it was 6.5. So we can see that the total SKU count per store is increasing, and this will be a key indicator to track over time to make sure the business is performing. But they say their internal goal is to get to 30 frozen SKUs per store against retail. So that just shows how much growth is left for Tattooed Chef, if of course they can execute. Moving on to what Sarah had to say. She mentions that the new Belmont confections will be able to produce virtually any bar, whether it's refrigerated, shelf stable, or confection candy, which is it shows the versatility of the acquisition. And she says that unique plant-based bars will be on shelf at some point next year. Scrolling down, she talks about the marketing campaign, which did contribute a fair bit of expenses to the business, but she says that it's outperforming industry benchmarks by 2x in terms of customer engagement for paid social. So it shows that the advertising spend that they are doing is, working greater than average. So, this is good. This will help drive brand awareness, and obviously brand awareness mixed with good execution by the business. Now on to Stephanie's remarks about the Q3 earnings. She starts off by talking about the reason why Tattooed Chef had to delay their earnings, and she explained that it was due to immaterial revisions of previous quarters, and this was classed as a technical accounting matter that primarily affected expenses classified between cost of goods sold and operating expenses. So really all that panic that everyone was getting worried about turns out to be immaterial. Doesn't matter. But yeah, I was never too worried about it in the first place, to be honest, but it's good to at least know why. She also mentions that the branded revenue is now 60% of the total revenue. And she also said that this is actually a slight decrease from last quarter, but this is due to the private label revenue that is being, now pushed through Foods New Mexico, which, it's fine. It's no big deal. Honestly, it doesn't really matter at all. And one of the analysts asks about the revenue downgrade, and she explains, like I explained before, it's due to the lack of promotions in the club channel that we'd normally see at this point in time. So no sort of big deal there, in my opinion. But this is a really nice thing. She explains that we should see some profitability in 2023, which is really exciting. And we've seen a lot of growth companies, when they hit profitability, just go and have a look what happens to their share prices. So we're thinking that it's going to happen in the back half of 2023, but she doesn't want to get too specific. But look, if it happens in 2023, that's good for me. I'm happy with that. And then sort of the analyst questions her again about the sort of revenue downgrade and some of the challenges in the club channel. And then again, she explains that Q4 is sort of seasonally weak in the club channel for promotions of sort of health-based food products. And she says that we should expect an uplift on Q1 and Q2 of next year. So hopefully that will reflect in strong revenue growth for the sort of first half of next year. But yeah, I would say like it seems pretty standard. She also mentions that we won't be affected as much this time round, as now we're more diversified across different channels. We're not so heavily reliant on the club channels, so this won't hurt our growth so much. But on the upside, I suppose, like when we do have those promotions in club channels, it probably won't boost our revenue as much, but that's just a part of getting bigger. So guys, overall, look, I was kind of disappointed, in all honesty, about the sort of revenue. I was half expecting it though, especially given that other businesses in the sort of plant-based food like industry, such as Beyond Meat and Oatly, they downgraded their earnings. And in terms of like the gross margin contraction, that was no surprise whatsoever. Of course, they were going to be affected by inflation, just like every other business that sells physical products, particularly with that freight cost. you know, Tattooed Chef, they are vertically integrated, but yeah, it's not like they own their own like shipping sort of like their own shipping business or anything like that. So they are going to be affected by things like freight costs. So I mean, the business seems to be performing fine. 44% revenue growth is like nothing to be mad at, especially given the current conditions of the market. I'm happy to hear that they think they're going to reach profitability in 2023. Uh, I think they're still on track to meet their long-term sort of revenue projections of $1 billion in revenue by 2026. So I think my thesis there remains intact. And look, we can see that the stock fell 2.75% sort of on earnings, and it's sitting just below $16. So I might even start nibbling at some more shares. My conviction with the company is still the same. Look, there's been some hiccups around sort of reporting and whatnot, but guys, like, I just don't. Obviously, it matters, like, but what really matters is the revenue growth, the store expansion, the products that they're creating, and being able to like drive profits at a later date, whether that be 2023 or whatever. But that's pretty much it for this earnings. Now I'm starting to ramble, guys. Make sure you like this video, subscribe to my channel, and thanks for watching.